Hi everyone, nice to see you again, guys. Welcome to this live session. As always, we are going to review a bit what's going on in the market, both fundamental and technically. One word of advice, not really advice, but one word before starting. Oil keeps leading the way in the markets, right? We have seen the commodity recover last Friday and setting measures all the way towards different directions, in opposite directions, sorry, of the ones they were heading through when the commodity was fall, with oil higher, favoring a recovery in Aussie and Canadian dollar, commodity-related currencies. And all of a sudden, oh, sorry, guys, I'm not having a good day. Anyway, the gold recovery, oil recovery, let's go back. Oil recovery last Friday has reversed market's direction, and all of a sudden this Monday the commodity began to fall again, mostly because Iraq oil ministry said that the country was producing around 42 million barrels a day during December, and we have been worrying about an oversupplied market ever since last year, and these are really not good news when you're thinking of an extreme offer and little demand in a certain market, right? Anyway, oil prices are leading the way, and we may have macroeconomic news, we may have trends, we may have technical signals, but if we have sudden or violent moves in oil and reversals or whatever, or breakout of critical levels in there, right, currencies will likely follow through. So keep an eye, really keep an eye on whatever oil is doing these days, okay? It's the number one rule for this week. Anyway, let's start by taking a look at the fundamental calendar for these days. I guess you're seeing my macroeconomic calendar. Give me a second. Here we are. Well, we have a few figures to care about today. The fact is that I believe that the market service PMI in the US could be the more relevant reading we had ever since a couple of months ago. The market readings in the US have been a miss, right? So if this, and we are actually expecting a small contraction from December figure in the preliminary number in January. So beware of this, because this is telling us that the US is not doing that good, right? And that could signal that the Fed may not raise rates at the fast pace the market is expecting, or may not, or whatever. And the speculation of a delay in rate hikes will probably put the dollar under pressure, right? Speaking of which, I do believe that the most relevant event of the week is, of course, the Fed monetary policy meeting next Friday afternoon. It's Wednesday, sorry, afternoon, right? And of course, we are expected to left rates unchanged. We are not expecting much much news coming, okay? No changes in the economic policy. Additionally, we have no press conference scheduled for after the decision. So most of the market attention will focus in the wording of this policy statement. And if there are any changes in the outlook of inflation, in the outlook of the economic situation, if the Fed is more dovish than previous, more hawkish, I'm not expecting much tips on upcoming rate hikes beyond what Yellen has already said, that is that it will be a slow pace in the raise of rates. Anyway, I'm not expecting this to make too much noise in the market. Keep in mind that right afterwards, we have the Reserve Bank of New Zealand interest rate decision, and there's a good chance that they may cut rates, right? We have been speculating with Canada, Australia, New Zealand cutting rates lately, and most of the market may be already pricing in such rate cuts. So if they stay on hold, we will probably see a sharp bounce in the New Zealand dollar. Okay. Anyway, that's for me the most relevant info we have. On Thursday, we have in the US durable goods orders. I'm not really much concerned about the UK GDP, we are expecting a slightly tick higher, but to be honest, data has been disappointing in the UK and the pound has been bearish, and we are going to see much more of that in the coming weeks, unless we have a really shock towards the upside in the year. In fact, I would expect a negative number. Anyway, I do believe that the next relevant event will be this Bank of Japan monetary policy meeting on Friday. As you know, the market is expecting them to do some easing. Okay, they have surprised us with a modification of their quantitative easing program, stimulus program, last December. It was not actually an extension or more buying of bonds, so actually it was not a big surprise. But anyway, market is still expecting Bank of Japan governors Kuroda to extend its easing, okay, because Japan remains far away from the 2% inflation target. Okay, take a look at the national CPI rating, 0.1%, really lousy numbers, so we are not expecting much in here. Okay, take that into account when trading Japanese yen. So market is pricing easing, and if they don't deliver, Japanese yen may strength on Friday. Okay, I believe that is the yen is strong and will probably continue rising. We are going to take a look at charts right now. And finally, the GDP figures in the US. If I'm not wrong, this will be the preliminary reading of the fourth quarter, which is the advanced one, which is usually the most relevant and the one that triggers most moves. So it will be pretty interesting to see if sorry, if the US continues growing or not, right? And if we see some growth, something about this 1.3, something I would like to say something about 1.5, that I would believe that the dollar rally could be more supported, right? It's not about speculation, it's not about rates, it's also about positive data showing economic growth. That's the factor we are missing these days, to see the greenback actually rallying on his own. Okay. Anyway, let me change. I'm going to take a look at charts right now. Okay, here we are. As I was saying, most of what the market is doing is related to whatever oil is doing, right? Yeah, late in the yes afternoon on Monday, commodity break below the 30 mark, and all of a sudden the euro was rising, the Japanese yen was rising, and the Aussie and the Canadian dollar were heading uh, uh, lower against the greenback, right? And all of a sudden, this Tuesday, the commodity is recovering. So actually, the OCF is recovering, the CAD is recovering, and the euro and the Japanese yen are easing against the greenback, right? So I do believe that the pound, if you want to follow the correlation in pound and oil, it's not as firm as in with the other four currencies, but it will probably do whatever the OCO can do. That's it, strengthen pound strengths when oil strengths, and pound eases when crude eases, right? So these three go in one direction and these two go in the opposite one, right? Weaker euro, weakened yen with a stronger dollar. Crude, sorry. Anyway, we had no data in Asia today. We have no data practically in Europe today. So as you can see, these movements are following this one, right? Again, keep an eye in here. It's really, really important. Anyway, and for the euro dollar, the fact is that we have seen little progress in this particular pair over this past few weeks. We have been trading range bound in between Fibonacci levels. The December rally is still in place. The correction towards the 61.8% has resulted in a bounce that it's actually resulted in lower highs. So I do believe that the risk has turned towards the downside slowly but steadily, right? Last week we have been challenging the base of a range, and the 50% retracement of the same rally around 780, right, with Draghi on Friday. with oil recovery. So I do believe that this is the area right now, 770, which is the post rally low, 780. That's the level to take, right? And we are 40 pips away to see a steady decline towards this lows and the 61.8% retracement of the same rally, 710, 715, right? That's the level. Of course, if we break that level, I would expect a stronger decline, a more firm dollar, but still can't see that. And towards the upside, what I have been noticing in this particular pair is that 925, 930, the region has been steadily attracting selling interest. Honestly, with the rally now starting below 900 today and the downside resuming, it seems we are not getting anywhere close that level today. Plus, it's being reinforced by this daily descendant trend line. So this region in between 930 and 960 should contain the upside, sorry, and attract sellers. And we really need to take that level away from to see the pair a bit more bullish, right? Which I can't see right now. Anyway, bearish below 780, further declines towards 720. That's what I'm seeing right now in there. And for the pound, as I was saying, it has an inverse correlation with the euro in the case of a market being led by oil, right? In this case, as oil rises, the pound also rises, but still looks pretty bearish for me. Fact is that we may have found some entering bottom, but nothing is telling me that the pair can recover or correct higher. In fact, we have that corrective movement and we're already down. It seems like rather that we are going to enter a consolidated stage, as I would like to see the pair recovering above this 4360, right? Region to talk about a firmer recovery or an upward corrective movement here. In the meantime, bearish tone persists, and I would take spikes or advances, intraday advances, a selling opportunity. For today, my resistance are around 42.60 and 43.10, the highest one. I don't see the pair advancing much more than that for today, right? And I could like to take my chances with tight stops around these levels and sell the pound again, okay? Below the daily low, which is 41.70 or so, I could expect the pair to decline back towards 40.90 or 40.80, the lows we have set last week, right? But overall, I do believe that the bearish tone in here still persists. And when it comes to the Japanese yen, the fact is that we have this sharp decline in between December and January, and last week rally started around 38.2% retracement of that decline. So actually, that's why I'm still seeing the pair bearish. Additionally, in the daily chart, particularly where my 100 and 200 moving average are, right? And the distance in between both is growing. So that is telling me that selling interest is still selling interest is still stronger than buying one, okay? So downside still favor for me in here. And this Fibonacci level has been huge, because if you take a look at smaller time frames, it had to try several times to overcome it and fail it. So beware of approaches to that level being taken as selling opportunities. Anyway, and despite the long-term picture is bearish, we may retest that 1890 in the coming hours, given the short-term picture is bullish. The next resistance comes at 1935 region. We have stalled around that level plenty of times during the past 2 or 3 months. So if you are attempting to sell this, should be against that level, as a clear break above it may signal a recovery up to 120. Okay, and on the other hand, the other Fibonacci level, the next Fibonacci one, the support around 17 has been pretty good in attracting buying interest. So I would like to see a forward candle opening below this area to see the bearish continuation. and probable retest of the 16 region, the lows post in August and this January, right? Those are for me the more interesting pairs taking outside. I was watching that we had that rally in gold late December. We have a downward corrective movement, and now we are breaking above those highs, but still below November high. Anyway, the pair is at fresh multi-month. The commodity is at fresh highs, and the early rally is being raised as risk aversion is easing. But overall, I do believe that we have found a bottom in the recovery. And it's the first time I'd say this in, I don't know, centuries. Anyway, this is a perfect, almost perfect rounded floor, right? We have a nice figure, a double bottom. Everything is telling me in this daily chart that a bottom has been put in place. Whether the commodity will continue recovering or not is yet to be seen, right? Risk sentiment is being huge these days in leading the market. And of course, it will depend on oil. But if oil plummets again, then there's a good chance that the gold can get the boost it needs to break higher. Anyway, it's trading below the 200 simple moving average in the daily chart, which is around 1120, right? So I would like to see break above it, or they can open above it to further confirm a bottom has been met and we have scope to continue advancing. I'm not seeing a huge rally, right? I'm not seeing a long-term run, but I certainly believe that the commodity can recover some further ground and maybe up to 1200, right? And this is at least what I'm seeing in here. Anyway, still, I'm reluctant to take much too long-term trades because of the market being light on sentiment, right? And nothing else. Anyway, when it comes to the Australian dollar, the fact is that ever since breaking below this trend line a couple of weeks ago, and even completing a pullback and sending a lower low, I still don't see much of an upward potential in here. And I do believe that the currency is trading on reflection of commodities and oil and gold and ore and copper and so on, but doing nothing on its own, right? We are not going to have big news in Australia until the beginning of next month with employment and the Reserve Bank of Australia meeting. So until then, I do believe that the pair will depend on sentiment and continue flip-flopping. Still seeing it is having a hard time to establish above 70 and spikes above the level of seen as selling opportunities by the markets. So I would support the downside in here as long as from the technical point of view, okay? At least that's what I'm seeing in the market these days. And anyway, I believe that's it for today, guys. I have not much more to share. It has been a pleasure to be here with you guys, as always, and see you back next week, okay? Thank you, and bye-bye.